welcome to this month's Financial Markets Update. Well, I don't think it's an understatement to say that February was one of the more incredible months that we've seen over the last couple of years, and we have certainly seen a few, I think it would be fair to say. Led by the Russian invasion of Ukraine, global equity markets were sold off particularly heavily at the back end of the month, whilst commodity prices reached all-time highs, particularly commodities such as oil and wheat as an example. As we sit here today, the fighting in Eastern Europe certainly shows no signs of abating, and combined with the economic sanctions that many Western governments have placed on Russia, commodity prices continue to remain elevated, and in our view will continue to push higher throughout the course of this year, certainly on the back that sanctions from our perspective are going to be multi-year in nature. So commodity prices are going to continue to push higher across a number of the key commodities, particularly when we look at the supply side and the constraints on the supply side, with Russia and Ukraine being important contributors around oil, wheat and other major commodities into global markets. Our local market was up, despite all the challenges, up around about 2% over the course of the month, but as I said, global equity markets were heavily sold off, with global equities down anywhere between 3 to 6%. We saw the biggest declines in Europe, but also the US market, S&P 500 as well as the Nasdaq was sold off heavily and were down roughly around about 3% over the course of the month. Bond markets were also down, and we saw bond markets both domestic and global down roughly around about 1 to 1.5% through February, so there was no real respite for investors either in growth assets or in defensive assets. As I said, the only upticks that we saw across financial markets were in commodity markets that continue to rally, as I said, on the back of those supply constraints and obviously demand still remaining high. The other important point to note that we saw throughout February was obviously testimony from the US Federal Reserve, and as we have noted on numerous occasions, inflation both in the US but right around the world is now running at levels north of central bank targets. We're even seeing that here domestically somewhat, and that is forcing central banks to consider raising rates. And US Federal Reserve, the testimony by Jerome Powell, definitely indicated that the US Fed would move in March. We originally anticipated a 50 basis point move, but we think that may be moderated somewhat on what we're seeing in Europe. But the Fed has certainly locked in a 25 basis point rise, and we expect more rate rises to come, certainly when we look at inflation in the US running well north of 7%. And we've just got a couple of charts to just sort of highlight some of the issues that we're seeing around inflation, the impact that we're seeing in terms of higher commodity prices, and obviously what that then means for central banks. And this first chart here is just giving you a snapshot in terms of commodity prices, so broad-based commodity index and the US inflation rate. And you can see really the low point of the cycle was back in the early part of 2020 when COVID was really starting to take hold. We obviously saw a significant drop in demand for goods and services, and that obviously led to a significant decline in inflationary expectations. And really through that middle part of 2020, increased fiscal and monetary support came to the fore. And then as we start to get to the back end of 2020, with vaccines starting to be rolled out globally, pent-up demand that was put into the system just through fiscal and monetary support really started to come to the fore as consumers really looked to, as I said, increase their spending. And that led to obviously significant shortages, both in terms of supply shortages of goods, but equally labour and freight shortages and the whole logistical challenge that we were seeing. And that led to a significant uptick in inflationary expectations, and that uptick in inflationary expectations really hasn't moderated, as you can see, through the rest of 2021 and now into the early part of 2022, and certainly with commodity prices moving higher pretty much throughout the entire period from the low point back in 2020, but now we've started to see that significant uptick in commodity prices on the back of the conflict in Ukraine. We see inflation now running well north of central bank targets, and that's going to lead to central banks being more aggressive and more consistent in the way that they look at managing monetary policy going forward. And that's another headwind for financial markets, and certainly particularly for bond markets. And it's not surprising when we look at bond markets that despite the challenges that we've seen and the conflict in Europe, we haven't seen a big shift downwards in bond yields. And really, as I said, central banks need to deal into that, and therefore bond markets are reacting, and we've seen bond yields either move flat, sideways, or in most cases actually move higher. Another chart just to show what we're seeing here domestically is on the domestic inflation side. You can see here that Australian inflation is at a headline rate is actually again travelling north above the 3% target band set by the RBA, nowhere near half of what we're seeing relative to the US. And if you in fact allow for the volatile items, inflation is running probably just at sort of the upper to mid range of the RBA target. So domestically, as we've spoken previously, we don't anticipate that the RBA is going to be aggressive in terms of its moves. It potentially may look to the second half of this year before it starts to increase official cash rates, but we think it's going to be a lot more cautious in regards to its rate rises. And one of those key elements associated with that is that we just haven't seen the same level of wage growth domestically relative to what we've seen in other countries such as the US. And again, the wage growth here, roughly around about sort of 2.3%, is half of what we're seeing in the US. But in the context on real wages are actually still negative here in an Australian context. So even though the unemployment rate has come down quite materially, as I said, wage growth remains relatively anemic, real wages are still negative. And in our view, when you actually take out some of the volatile items on an inflationary side of things, inflation is still within the RBA target band. So the potential for rate rises here is absolutely there, but we think the RBA is going to be far more cautious in terms of positioning rate rises going forward. And the final element that we saw throughout the course of February was obviously the domestic reporting season, and clearly occurring in a pretty challenging market environment. When we look through the reporting season, from our perspective, it wasn't too bad. When we look at companies on a percentage basis in terms of where EPS growth was above the expectations versus companies where EPS growth was missed the earnings outlook, that was roughly around about split evenly across the board, around about 38% each. Whilst companies that reported in line was around about 24-25%. So by and large, the earnings season was a reasonably strong one, and again we saw that reflected in the performance of the local equity market. And I think just a couple of charts to highlight on the back of where we saw that earnings season, and the chart here just really is highlighting both the earnings outlook, forward earnings outlook, as well as what we're seeing in terms of dividends as well. Particularly important in the local equity market context. And you can see here that the EPS outlook for the ASX 200, the broad-based index, is tracking north of what we're seeing in terms of overall performance of the S&P, of the ASX 200. And so from our perspective, we think that there is still some underpinning for the local equity market to move higher. Certainly, obviously, there's going to be some geopolitical risks associated with that. But the earnings outlook, does look stronger, and from that perspective, we think that on the back of that, if that can be maintained, then the market still has the capability to move higher. And the second element associated with that, if we think about the dividend side of things, corporates are now, being able to replenish their balance sheets over the last couple of years. So we have started to see an uptick in dividends being paid out. And you can see there that we do expect also dividends to continue to move higher over the next 12-month period. And we think that that is also a positive catalyst for the Australian equity market as we sit here today. But overall, it was an incredible month, and we think there's probably still a number of these to go. The big issue clearly is what we're seeing in Eastern Europe in terms of the conflict, but the knock-on impact of sanctions, which we feel are going to be with us for a number of years. They're certainly not going to dissipate quickly, no matter how soon the conflict ends in Eastern Europe. We think that Western powers are still going to be quite aggressive in their sanctions on Russia, and that's going to have implications for financial markets. But more importantly, going to have significant implications for commodity markets in the short to medium term. And I think from that perspective, that's going to be something that we're certainly going to be focusing on, and what that knock-on impact will have in regards to overall performance of equities, as well as obviously bond markets. But certainly commodity markets in the near term, in our view, will be well supported. As always, if you have any queries, concerns, please feel free to reach out to anyone in the team. And as I said, we look forward in catching up again next month. And thanks, and bye for now.